Things just got a lot more complicated for the Federal Reserve Bank. Let me explain. According to CNN, former President Donald Trump may have caused major disruption on Wall Street. First, Trump sent a letter announcing his intent to fire Jerome Powell, the chairman of the Federal Reserve. But just one day later, he reversed course and said he isn't planning to fire Powell, at least not yet. Now add a fresh layer of complexity. Inflation is no longer decreasing. It's on the rise again. Why does all of this matter? Trump is pushing hard for aggressive interest rate cuts. He wants rates to fall as low as 1%. But the authority to decide whether interest rates go up or down lies entirely with the Federal Reserve Bank. Here's where things start to get interesting. The Fed usually cuts interest rates to boost the economy. That's exactly what they did during the pandemic, when the economy came to a standstill. They slashed interest rates to historic lows to encourage borrowing and spending. On the flip side, the Fed raises rates to cool things down, especially when inflation is high. That's why in 2022, after inflation surged, the Federal Reserve increased interest rates 11 times in a row to stabilize prices. Now fast forward to today, the economy appears strong, but higher interest rates are making it harder for people to afford things like mortgages, car loans, or business financing. That's why Trump is demanding the Fed cut rates immediately, to jumpstart economic growth. But up until recently, the Fed has resisted, warning that tariffs could make inflation worse. So they've refused to cut rates. At this point, you may be wondering, if the Fed won't cooperate, why doesn't Trump just remove Powell? Well, it's not that simple. Firing the Fed chair would create massive uncertainty in the markets. Plus, the Fed isn't actually part of the federal government, so the president can't easily fire its chair. But here's the twist. Now, even the Fed's messaging is changing. Previously, they said tariffs were the primary concern. But with the latest inflation data showing prices climbing again, they've shifted focus. Now they're saying inflation itself is the main problem, not just tariffs. And this is causing growing friction between the Fed and the federal government. That tension is making Wall Street nervous. More conflict between these two major institutions could mean more volatility in the markets and more uncertainty in the economy overall. But for savvy investors, uncertainty often creates opportunity. The latest inflation report shows overall inflation at 2.7% annually, while core inflation, which excludes food and energy, is at 2.9%. The Federal Reserve's target is 2%, so we're still above that mark. Why does this matter to you? If your income, savings, or investments aren't growing faster than inflation, you're effectively losing purchasing power. For example, even if your money is in a high-yield savings account, earning 3.5% annually, you're not necessarily winning. Why? Because interest earned is taxable. If your effective tax rate is around 25%, then your real return drops to approximately 2 to 6%, which is kind of lower than inflation. That means your savings aren't keeping up with rising prices. And remember, some inflation effects, especially from tariffs, haven't even been fully felt yet. The Fed believes that tariff-driven inflation could rise later in 2025. However, the White House disagrees, claiming that tariffs won't contribute to inflation. So who's right? We don't know yet. But here's the point. My job isn't to guess what will happen. It's to help you prepare for any scenario. And the best way to do that is by learning how to beat inflation. You might see 2.7% inflation and think it's not a big deal. But in reality, you're probably feeling much higher inflation. According to the latest data, energy costs are up 7%. Auto insurance is up 6%. Sure, housing costs are up 4%. So how do you beat inflation? Ask yourself this. Who benefits from inflation? The answer: investors. As inflation rises, companies typically raise prices. That money ends up in the hands of company owners, also known as shareholders. Over the last 5 years, we've seen inflation rise by 24%, while the stock market is up over 90%. Of course, investing isn't always easy, especially when prices are high and wages aren't keeping pace. Inflation has compounded year over year from 2021 to 2025, while incomes haven't grown fast enough. That makes saving and investing even harder. But it's never going to get easier. If you don't start now, it'll be even tougher in 2026 and beyond. So how do you start? Use my 75, 15 to 7, 10 rule. Spend 70% of your income. Invest just 15%. Save 8 to 10%. Open 3 separate bank accounts. 1 for spending. 2 1 for investing. 3 1 for saving. Now you've got a system. Every time you get paid, divide your income accordingly. That gives your money direction. Once you have investment money ready, where should you put it? If you have high interest debt like credit cards, pay that off first. Then build at least a small emergency fund. After that, start exploring investment options. You can invest in books and courses to grow your financial knowledge, the stock market, real estate, small businesses. There are many paths, but the key is to just start. The biggest mistake you can make is doing nothing because you're stuck overanalyzing your choices. Whether it's stocks, ETFs, real estate, or crypto, don't let analysis paralysis hold you back. Some people prefer passive investing in the S&P 500 and forget about it. Others love the research and aim to beat the market. And some avoid stocks entirely and prefer real estate. Remember, personal finance is personal,